On 26 June 2025, President Bola Tinubu signed the 4 tax reform bills into law. These laws include the Nigerian Tax Act, the Nigerian Tax Administration Act, and the Nigerian Revenue Service Act, the Joint Revenue Board Act, collectively referred to as the Act. The Act comprehensively overhauls the Nigerian tax landscape to drive economic growth, increase revenue generation, improve the business environment, and enhance effective tax administration across the different levels of government. Anyway, this is no longer news. The news is that the acts are being gazetted by the Federal Republic of Nigeria. Now, let's do a holistic analysis of developments around this act. Now, Mr. Albert Folorunsho is my guest. He is a managing consultant, Christine Penabo, a member of the Presidential Fiscal Policy Tax Reform Committee. Thank you so much. It's really good to have you here again.
Thank you for having me again. Now that the law has been gazetted.
Yes, so we can talk really more about it.
Of what we have seen in the law.
You know, just like I said earlier, the 4 laws, and you've also attested to that, are being gazetted. Let's start with the Tax Administration Act 2025. Can you help us align major objectives around this act first, and key applications, key parameters to be known, particularly by the public and the business community?
Thank you very much. The Tax Administration Act is specifically around the administration of taxation in Nigeria, specifically relating to the need for registration by individuals and companies for tax, the basis for the registration, what you need to obtain, your tax identification number, and all that. The type of returns as a company that you need to file, as an individual that you need to file, with which relevant tax authority, what are the penalties for failure to file those returns, and of course, after filing your returns, how do you make payment? Who do you pay to? Do you pay to the state, to the federal? All of those are well specified in the Tax Administration Act. And of course, it also talks about the basis for deployment of technology for taxation in Nigeria, which has become very critical. The issue around fiscalization, the issue around e-invoicing, which is all over the place now.
Yes.
Revenue is going around educating the taxpayers, particularly where your turnover is above 5 billion. From 1st of August 2025, you must deploy e-invoicing technology, which means your transactions must be captured instantaneously as you are carrying them out. All of those are laid out in the Tax Administration Act, as well as the relevant authorities, the state authority, their composition, their board, their functions, the local government revenue committee, and of course, the issue around investigation, tax audit, functions, what can be audited, what cannot be audited, what is the scope of investigation, what will trigger investigation. All of those are well captured in the Tax Admin, as well as penalties and offenses and penalties where taxpayer fail to comply.
Yes. Again, let's talk about the tax ombuds and expected impact on activities. I'm wondering, what used to happen before we had this tax ombuds? What used to be the situation before the establishment of this?
Okay, so that is just a dispute resolution arm that has just been introduced.
Yes.
Before now, what you have is when the tax authority raises an assessment on you as a taxpayer, either a company or individual, you have the right of objection. So you can either pay if you don't have any objection, or if you have objection, you have the right to object within 30 days, stating the right of, the reasons why you are, the grounds of objection. That's what we call it, the grounds of objection. When you object to the tax authority, they review your objection. If they agree, they will revise the assessment. If they don't agree, they issue you what is called notice of refusal to amend. And thereafter, if you still don't agree as a taxpayer, the only option you have is to go to the Tax Appeal Tribunal, and then from the Tax Appeal Tribunal to the Federal High Court, from Federal High Court to the Court of Appeal, and then to the Supreme Court if parties still don't agree. But the only thing that has been introduced now is that, and it is not even compulsory, that before you go to the Tax Appeal Tribunal, the tax ombud can intervene between the taxpayer and the tax authority. They can review what the tax authority have done. They have some level of power that has been given to them in the law. They can investigate the tax authority as well as the taxpayer, just to find a way for them to, resolve or iron out whatever issue that may have created the dispute between the tax authority and the taxpayer. And like I said, It is just a mechanism that has been designed by government to particularly support mostly going to be small taxpayers who probably cannot jump into the court straight away, but they want a situation where the issues can be resolved out of court, and then if they can still not resolve at that stage, it goes through the normal process, go to the joint, the tax appeal tribunal, and then Federal High Court, Court of Appeal, and so on. So that is that. That is the tax ombud.
Looking at the gazetted documents, voluminous indeed, I must say, tried to go through a bit of them. What specific areas do you think will require amendments or needs to be reversed, if possible, in the entirety of this act?
Okay, so like you said, the copies have been all over the place, and what we have is now the gazetted copy. Yes. And going through those gazetted copy, there are quite a number of things that one will want reviewed as quickly as possible. For example, the corporate tax for company remains 30%. And in addition to that, there is the development levy of 4%, which is 34%. In neighborhood countries that we have, the rates are coming down, not going up. So we expect that in the very near future, government will trigger a situation where the rate will come down a little bit, maybe to about 25%. In fact, if that can be done even before the implementation, which starts 1st January, kicks in, it will be very welcome by the taxpayers. It should come, the corporate tax should come down. Next is the VAT. The VAT rate remains 7.5%. In addition, the provision has been made that you are eligible to deduct your input VAT, which means by the time you apply 7.5% on what you are selling, which is going to be your output VAT, you are allowed to deduct all your input VAT on your fixed asset, on your overhead, as well as on your items that you are buying and selling. So which means it's going to leave the government, I mean, from my estimation, out of pocket. And so for a reasonable, a competitive rate, we expect a marginal increase. In fact, it has to be considered in the rate of VAT from 7.5%. It may not be a popular suggestion, but that is what we have to have for us to be able to have total deduction for all your input. In addition, I have seen in the provision of Section 197 of the Act, which now restricts, it says that the provision of the PIA in Section 14, paragraph 14.6 has been deleted, which means as under the production sharing contract, the operators, the production sharing contract is between the federal government and the oil company. And that gives the tax authority, I mean the oil company, the right to claim capital allowance on the asset, even though we know there is cost recovery, which all of those assets are part of the bucket of what the oil company will have recovered. Okay? But they still give them the concession to claim capital allowance on that. With the deletion of Section 4, I mean, paragraph 14.6 of that PIA, it means that oil companies that are engaged in production sharing contract arrangement with the federal government can no longer claim capital allowance on those assets. That is very huge. I'm not sure that was envisaged when the public hearing and all that was going on. In addition, capital gains tax. Capital gains tax of 30% for companies. Yes, I don't have anything against that, but it's huge. It affects foreign portfolio investors. If you invest in Nigerian capital market, for example, and you dispose your shares, and if the volume of what you sold is above 150 million, or maybe the profit, the gain you make is more than 10 million, and you did not invest, it means you are liable to capital gains tax of 30%. That is also huge. That is not even the problem. The problem is really when it comes to normal for individuals. Individual means that you are also supposed to pay the capital gains tax rate at your own individual rate. Every individual taxpayer has his own rate, depending on your income level. Income of individuals are placed on what is called the graduated tax table of rate. The first 800 is 0%, the next 2.2 at 15%, the next one at 18%, we have 21% and 3% and all that. It's going to be difficult to say that you have sold a property as an individual in Lagos, you want to perfect, and the tax authority is looking for your effective rate to be able to determine what CGT, capital gains tax you pay. Presently, you don't even see the seller. It is the buyer who wants to perfect title that goes to the authority to be able to perfect the title. Yeah. And so what currently happens in so many states is that they just use a nominal rate of maybe 2 or 5% on the proceed that has been, disclosed. I think something has to be done on that. I mean, when you are talking about immediate changes, that is very critical. A lot of people have also complained around the nuisance taxes, all these taxes by the subnationals.
Yeah, states and local governments, right?
That was not under the purview of the National Assembly. It has to be done by the state and the local government. A lot still has to be done on that. I know the committee is working on that to be able to remove all those nuisance taxes with cooperation with the state government. That is another big one. One other thing that I think is hitting up the investing community, or maybe the international community, we don't care. Trump is also slamming tariff here and there. Yeah. There is a 4% that has been included in our law, which applies to non-resident entity carrying on business in Nigeria. So when they generate income in Nigeria, particularly where they don't have significant economic presence in Nigeria, or they don't operate such business through what is called permanent establishment in Nigeria, the law now says that whatever you generate in Nigeria will be liable to a 4% tax. Okay, 4%. Of course, some of those income are liable to withholding tax. If that withholding tax is not up to 4%, you will pay 4%. That is a huge one. We want the international community, we want our residents to... It's not that we want them to take away our tax. We don't want base erosion. But of course, I think it's something that we need to consider. And again, payment of tax. We want Naira to be strengthened. When you continue to insist on everybody to pay tax in the currency of the transaction, in dollars, then you'll be looking for money to buy dollars. And then the rate... So there has to be immediate amendment so that you allow people who want to pay their taxes in Naira to pay in Naira, so that will reduce the pressure on the Nigerian currency. Those are things that I believe require immediate review. You just touched on the CGT because I wanted you to dig deep into the implications of that. And I think you've talked about how it also applies to individuals and properties, selling properties and buyers. I think you've touched on that already. But let's stay more on the nuisance taxes. Can we say businesses are now free from those harassments now? What's the situation regarding those levies, fines, taxes? Okay, those levies came into Nigeria, enacted in 1998 through Decree 18 of 1998. And it was, after the military, it was also gazetted and became act. So there are laws that are under the subnationals, the state and the federal government. Of course, the laws listed out the taxes collectible by state, by federal, and by state. But the main issue regarding those nuisance taxes, we call them nuisance taxes because most of them are not really genuine taxes. All those road blocking, you will not find them on the list. But there's a lot that are on the list, like advertisement, TV, pollution, all sorts of taxes that are that are obstructing free flow of business. For example, if you take a truck from Lagos to Kano, you will know how much you pay from each state to the other. Yes. All of those are being synchronized and harmonized. And hopefully the Joint Tax Board, now the Joint Revenue Board will come out with something solid on that. But the fact is that has not been addressed in these laws. Okay, those nuisance taxes have not been addressed. They are being addressed. Continuous engagement with the state governors who are more or less, have overriding power with the relationship with their, arrangement with the National Assembly. So those laws are still there. We believe that if the states see the output of these new laws, particularly the fact that the whole of stamp duty belongs to the state, the bulk of personal income tax goes to the state, huge percentage of VAT goes to the state. If they see the productivity of this tax reform, they will be more amenable to, reducing or removing all these nuisance taxes because they have control of them. They have control of the Okada rider. They have control of the road transport workers. They have control of all the people they send on the street to go and collect taxes, you know, with target and all that. They can't amend that, and we believe that by the time we begin to see the fruit of this tax reform and the level, the quantum of revenue that is going to be generating and the amount that will be going to the state, they will definitely support the government in removing all of those nuisance taxes.
Interesting stuff. Well, we hear minimum tax no longer applies for companies. Well, to avoid taxing capital and poverty, that at least without profit, no tax is due. But there is a talk about global minimum tax, which has been imported into Nigeria. My question is, why is it being extended to only Nigerian companies?
Okay, so you're talking about the global minimum tax, or the top-up tax rate of 15%. If you look at the provision of the new law, it says that one thing is that the minimum tax, the old minimum tax that we're familiar with, which is 0.5% of turnover, that has been removed, which means it is not based on turnover, it's not based on capital, it's not. So the new provision says that you must make profit for you to be liable to tax, which most people are happy. Yes, of course, it was imported and it's something that is being, you know, introduced to countries by the OECD, which is meant to avoid or to reduce the level of base erosion. I mean, the way taxes that should have been paid in Nigeria are shifted to other countries. That is the purpose. And based on the OECD provision, it is supposed to be applicable to only multinationals that operate in a group, and that such a group must have an annual turnover of not less than 750 million euros. Okay, if you're a member of such group, then that provision applies to the company. But what we have in our law is more like a modified form, which means if you belong to such a group, that provision still applies to you, but that has now been extended to companies in Nigeria that are not even member of any multinational, but as long as your turnover is not less than 20 billion a year, then this provision applies to you. How does it work? You take the profit before tax, so which means for this provision to even apply at all, you must have made profit. Profit before tax as per your account. Okay, that is the trigger point. So whatever tax that you have paid in Nigeria, which are all in the second chapter, the company income tax, the development levy, the capital gains tax, all of these are more or less referred to as what is called the covered taxes. If you divide that by your profit before tax, after making adjustment for 5% of depreciation, 5% of salaries and wages to that your profit, if what you get is less than 15%, then you need to top it up, which means you will pay additional tax. Yes, I understand what you mean by why is it being extended to Nigeria, only Nigerian companies. Well, for competition, you know, multinationals also compete with big companies, and that is why there has been a threshold, so that this will be limited to only big companies. I don't know whether 20 billion now qualify as big company. I know there are suggestions as to whether the 20 billion is small. I'm sure that is one of the things government should be looking at to review. 20 billion is nothing in Nigeria of today. So I think we need to increase the base so that it can be really for multinationals. If you are not truly a multinational, or you are not a local company that compete with multinational, this should not apply to you. But the present provision is what it is. 20 billion, it will trigger. If you have profit, this will apply. And you know why is it minimum tax? Even if you can have profit and not have tax liability. So if you have profit and you don't have tax liability, it still applies to you. Tax liability as in normal tax computation. It can be zero, but you have profit. Okay? So you will still be liable to the 15% of your profit.
Interesting. Thanks for that.
I'm sure we will see guidelines that will be issued by the Nigeria Revenue Service. And we'll begin to understand how this goes, particularly.
Well, there's also this 5% tax called surcharge on fossil fuel in the new law. What's it about? What about the 4% non-residents, 4% for non-residents? Is this to block a leakage, or what really is it
Okay, so the 4% I already explained, which applies to non-resident entity that are operating into Nigeria or whatever they generate in Nigeria. They are liable to a 4% minimum tax. The 5% fossil fuel, that is a surcharge. A surcharge is like a levy that has been introduced in the law, which applies to, let me say, PMS, petroleum. That is fossil fuel. It has excluded green energy and all that. So it's strictly on fuel. So which means for every fuel that Nigerian buys, if the federal government trigger that provision, because what it means is that there is a need for trigger of that law before it can be applied. So which means that if the federal government did not make specific pronouncement on it, it will not even take effect in January 2026 like other laws. But if the federal government trigger that, it means that for every fuel that you buy in Nigeria, you will pay additional 5%. It is a surcharge. And I'm sure government is looking at all these Calabar and Sokoto Road, they're looking for how to raise money. And it's so easy to collect. See, Dangote is producing fuel. You don't even need to disturb anybody at the petrol station. Just add Dangote to add the 5%, and government will collect it. Very neat. It's a major source of revenue, and government can just trigger it anytime they require funds.
Interesting. So now the full implementation of this act is something that many analysts are worried about. For me, considering the fact that 2026, it's a pre-election year, do you foresee any challenges? Do you think implementation would be seamless?
I believe it will not be difficult to implement. It is just for proper guideline to come out on some areas that require some level of clarification. The implementation depends on the nature of tax that we're talking about. There are transaction taxes like VAT, stamp duty, even personal income tax is more, particularly for pay as you earn. Those ones, Section 203 of the Nigerian Tax Act says that this law takes effect on 1st January 2026, Section 203. So which means this law does not start until 2026. And so if it starts on that day, it means that effectively you can start applying that provision, particularly for VAT from that day, for stamp duty from that day, the pay-as-you-earn table, the first 800 at 0%, the next 2.2 at 15%, and so on. You start applying it from that day. But there are some taxes that are, some profit that are subjected to tax on what we call preceding year basis, which means the profit of year 1 will be taxed in year 2. So if the law says it takes effect in 2026, it means that what is taxable in 2026 will be the profit made by companies in 2025. There will be requirement for proper clarification on that. Because what it means is that all the profit you are making in this year, in this 2025, by the time the law kicks in on 1st of January, the provisions of the law will be applied on those profits. If you make disposal before the end of December this year, the provision of the law will be applied come 2026. So those are areas that we believe that proper clarification will be required by, and I know that guidelines are being worked on, or maybe like information circular that will clarify, on those specifics. I believe those are in the offing presently.
Finally, I'll let you say more about this, or what more you think we can to wrap this up. What's the status of pioneer status incentives and free trade zone entities?
So pioneer status incentive, was a provision that was in existence, to give relief or incentive or tax holiday to specific sectors of the economy where the government thinks require, development but have not been fully developed, or that are not even in existence at all. So that provision of pioneer is now referred to as the economic development tax incentive, which are specific for some sector, and we call it the priority sector. What it means is that if you are a business in that priority sector, you are eligible as a new entity, you are eligible for tax holiday. But the way it has been structured now with the new law, with the Gazette that has come out, is the fact that, yes, you don't need to pay tax, okay, which means for the first 5 years of your operation, if you qualify and you apply through the NIPC and you are granted, it means that as a company, you are not liable to tax. Your tax, but however, what is different is that your tax will be computed. Your assets that you use for the business will be used, you will calculate capital allowance on those assets. Okay? Before now, what happens is that the assets are deemed to be acquired a day after the expiration of the pioneer period. Okay. But in this case, you will use the asset, you will consume your capital allowance, there's nothing to carry to the new business after the pioneer, and then your tax liability will be computed. So that tax liability will now constitute a credit, which means you don't have to pay the tax. You compute the tax and you don't pay it. The difference is that it has consumed your asset because you have utilized your capital allowance. Another point is that under the new provision, under the old provision, when such companies pays dividend, the dividends are not liable to tax. Under the new provision, if you pay dividend, you will pay withholding tax. The exemption no longer applies. Another point on the pioneer, which we called priority sector now, is the fact that for such companies, the provision relating to the minimum tax can apply to them, which means you are not allowed to use such credit to offset the top-off tax, which is not a good thing at all. It's like, even though you are a pioneer company, you are a Nigerian company, but you are still made to pay tax anyway because of one global minimum tax that applies. Then when you come to the free trade zone entity, their original conception and objective is to assume that they are not in Nigeria. They are operating outside Nigeria, even though they are within the Nigerian territory. So the expectation is that they are not expected to sell whatever they are producing within the Nigerian territory, which we refer to as the custom territory. They are supposed to export. So if you are a free trade zone under the new provision and you export 100% what you produce outside Nigeria, or you are consumed within the custom territory without coming into the Nigerian territory, that is the custom territory, you don't have to pay any tax at all. Okay? But if you have to sell to the custom territory, that is to sell to Nigeria, you must not sell more than 25%. Okay. If you sell more than 25% of your turnover into the Nigerian custom territory, then whatever you sell into the custom territory will be taxed. Okay? And that provision, according to the new provision, will only remain until the year 2028. Okay. After the year 2028, if you sell 1% of your produce or your service in the custom territory of Nigeria, tax will apply proportionately. Okay? So that is the new provision. In addition to that, if you look at paragraph 10 of the second schedule that relates to export free trade zone, it says that they must produce evidence for you to even be exempted. You must produce evidence that you actually exported. Where has the cash gone? Where did you use the proceeds? Did you use it to import raw material or equipment? They want to see evidence. Okay? The law did not say that you should bring back your money. No, because you are ordinarily not within Nigerian territory by conception. But please produce evidence that you export, which is a good thing. They want to be sure that you're actually exporting. And in fact, they don't want to go the hog of saying, bring the money back, because that will be overreaching. Yeah. Because only Nigerian entities in the custom territory that are doing the same thing and exporting are required to repatriate their fund before they are able to enjoy the incentive. Yeah, so those are the things that have happened when it comes to pioneer and free trade zone. I think we've been able to dig deep really into this today. I must thank you so much for your insights, as always. Into that. I know there's always a lot to talk about this, but I think we hit it so very well. Clarity on many of this contending parts of it. Mr. Albert Folorunsho is the managing consultant. Kristen Pedabo is also a member of that committee. So interesting conversation, I must say. Thank you so much for coming into the studio again. We appreciate this. It is my pleasure. Thank you. And I'm always available. All right, then. Thank you. Well, Multipolitan's Wealth Report 2020